Hello traders, my name is Raul Rivera and this is the Market Profile and Orderflow 101. This is an introductory course on the most powerful futures trading indicator in the market. We're going to be going through all of the basics and all of the need to knows about the market profile. But before we get started, first the required disclaimer. First topic we'll go over is just a quick, brief history on the market profile. The market profile was introduced to the marketplace in 1985 by a trader named Peter Stadelmeier and was introduced as a CBOT product. The market profile is an intraday charting technique that takes an account of price and time and displays this information in the form of a bell-shaped distribution curve, where price is vertical and time is horizontal. It is also called a TPO profile, which stands for Time Price Opportunity Profile. This technique was originally created for exchange members by exchange members. It gave them a new dimension and a more in-depth look at price action. And what they discovered was that the bell-shaped curve was bigger in the middle than in the upper and lower ends of the distribution. They called this bigger area the value area, with its biggest part being the point of control. They have since used this technique on a daily basis to discover intraday market moves. So why trade using a market profile? Well, the market profile is almost like a crystal ball for the futures markets. At least that's the way I like to think about it. Depending on the type of distribution shape, we can assume with a degree of accuracy what direction the market can trade in successfully. We could also see that all markets look the same through the profile. There's no such thing as head and shoulder patterns, no cup and handles, no dojis, or other trading patterns that you may see but others may not. We could also accurately predict the direction of the market in both trending and non-trending markets. And that's something that's especially rare in today's electronic markets. There's pretty much an indicator for almost everything, but they'll either work better in trending markets than non-trending markets, and others will work better in non-trending markets than in trending markets. It's very rare to see an indicator or a charting technique that can perform well and predict direction in both trending and non-trending markets. It's also hard to unintentionally be on the wrong side of the market. This one's actually my favorite reason. We can see what market direction we will take very accurately. It's also reliable as well because others get the same answer that you do, right? 2 + 2 = 4 to me, as it does to you. It also pinpoints true levels of support and resistance so accurate that pivots and other trading systems just cannot match. And one of the biggest reasons is that hedge funds, exchange members, proprietary traders all use the market profile to trade. They may not say it out to the public or make it known to the public, but they use this information. Exchange members account for 66% of trading volume on ranging days and about 30% of the volume on trending days. So if over 50% of the volume traded is due to these traders, then we need to position ourselves with them and not against them. The retail trader is actually about 7% of all of the trading volume on any given day. So as you can see, the larger players use the market profile. They know what side of the trade to be on. And us, the individual traders using the market profile, we can be on the right side of the trade, and we could trade with these players rather than against them. So this brings us to our next topic and our next question. So what is a bell-shaped curve? Well, a bell-shaped curve, also known in mathematics and more specifically statistics, it is known as a normal distribution. A bell-shaped curve displays the probability of random occurrence to take place within a specific range. The probability is determined using historical data that's helpful for predicting the relative likelihood of future values. In trading, we can combine the variables of time, volume, and price to create a distribution pattern that measures the probability of future values. These distributions are important because they visually display where value is located in the market and where there is no value, and where historical behaviors are likely to forecast future behaviors. If you've ever taken statistics in college or even a psychology course, you may already be familiar with what a bell-shaped curve is. But if this is your first time learning about normal distributions and bell-shaped curves, you might be thinking to yourself that this is really complex stuff. But believe me, we're going to make a whole lot of sense out of all these distributions. And by the time we're done here with the presentation, you're all going to be pros at this stuff. Next, we'll be speaking about the value of distribution. So, all the market is trying to do is discover its most acceptable price, the fairest price. The same can be said for companies like Apple or Amazon. Every single day, we see the valuation of these stocks fluctuate continuously as traders and investors figure out what the most fair price is at the current moment. The fluctuations of price through a period of time can be analyzed in many ways. The market profile is one such way to analyze this data. And when using a market profile, there are a few components that you need to know about. Number one, the value area. This is where 60 to 70% of all trading activity occurred. Number two, the point of control. This is the singular price where the most amount of trading activity occurred. Number three, we must keep in mind that prices above or below the value area are considered to be extremes, or unfair highs and unfair lows. All of this occurs through what's called distribution, or the bell-shaped curve. A book of the market profile written by the CME has this to say on one of the first lines of the first chapter, and it goes like this. Distribution is the position, arrangement, or frequency of occurrence over an area or throughout a space or unit of time. The value of everything distributes around a mean over time. Why should trading volume be any different? Looking at the image to the right of the text, we can see a bell-shaped curve where price is vertical and time is horizontal. We can also see where 70% of all trades have taken place, which is the value area, and we could also see prices above value and prices below value. Sticking to the topic of the value of distribution, here's a fantastic real-life example of how distribution is used. So this is an image of a distribution from TrueCar.com. The concept behind finding the true value of a vehicle in your area is the same as the market profile. We can see prices that are below value, prices that are above value, and prices that are inside of value. Sticking to the example of a vehicle, as the seller of a vehicle, I would love to sell above value because I'm making a bigger profit than those dealers who are selling their cars inside of value. And as a buyer of the vehicle, I would love to buy below value because I'm getting a better price than those who are buying inside of value. Shifting this over onto trading, above value are unfair highs and below value are unfair lows. I want to be a seller above value and I want to be a buyer below value. Now, as mentioned in the previous slide, the volume of everything distributes throughout a mean over a period of time. So selling above value, at some point in time, we're going to revert back into the mean. And if we're buying below value, at some point in time, we're going to revert back to the mean. So in a trading example, if I'm short above value, I want to cover inside of value, and if I'm long below value, I want to exit my position or sell my position inside of value. I never ever want to place a long or buy order or short sell order inside of value. Too many transactions occur there, and I'm selling what everybody else is buying. I want to take advantage of prices above value and prices below value. This is how we can unlock the best bang for our buck. Now, I briefly mentioned what a time price opportunity is, but let's define it. So what are TPOs? TPO stands for time price opportunity. The definition of a TPO, though, is a bit misleading. What it stands for is not necessarily what it is. My definition on a TPO is that TPOs are variables that describe price ranges throughout periods of time. Most market profiles operate with a 30-minute time period. Each 30-minute period is labeled a variable, or a TPO. It can be a set of numbers, it can be shapes, it could even be letters. Letters are the most popular way of viewing a market profile. For example, if I'm using a time period of 9 a.m. to 9:30, which is a 30-minute period, I'm going to assign that time period a letter, or a TPO. So from 9 a.m. to 9:30, we're going to say that's going to be letter A. From 9:30 a.m. to 10 a.m., we're going to say it's letter B. From 10 a.m. to 10:30 a.m., we're going to say letter C. From 10:30 a.m. to 11 a.m., we're going to say letter D. In this example, I added a variable, or a TPO, to a specific range of time, a 30-minute range of time. Understanding TPOs is crucial to understanding a market profile and how it plots over time. Here's an example of what we mean. So letter A is the first 30-minute period of the day. We can see it here on the image of this profile. Letter B is the second 30-minute period. Letter C is the third 30-minute period. Letter D, fourth 30-minute period. And letter E, fifth 30-minute period. Also notice the value area highlighted in green, which is about where 60 to 70% of all the day's trading took place. Now, if you've never traded with a profile before, it may be difficult to understand how we get this pile of letters stacked on top of each other. Let's take a look at it in a different light, in a way that we all understand, which is candlesticks. If we take a look at a 30-minute bar, or a 30-minute TPO, is another way of looking at it. We can see the first 30 minutes of the day, letter A, and the high and the low of that bar. We can see the second 30-minute of the day, 30-minute period of the day, the high and the low of that bar. The third 30-minute of the day, the high and the low of that bar, so on and so forth. It's only when we combine it and we bring these all together that we get a distribution shape that looks like this. I hope this is making a lot more sense now than it was before. So why are all these components so important? Okay. Well, number one, support and resistance. Using the value area not only allows us to see the most fair prices, but also provides two interesting levels of support and resistance. These levels are the value area high and the value area low. These levels tend to be reactionary in the form of support and resistance. These levels allow us to see where we can expect either a reversal or the beginning of a consolidation period. Attraction. When speaking in terms of volume profile, we can see potential areas where prices can be attracted towards. High volume areas are like magnets or gravity. They pull prices towards those ranges. We see examples of this every single day. When speaking in terms of market profile, it is the same as the volume profile. What makes market profile unique versus the volume profile is that it is a profile based on time, not volume. Volume can decrease and increase, which makes it reactionary to market events. Time cannot be slowed down or sped up, making it less reactionary to swings in the market. And also rejection. In terms of volume profile, we can see potential areas where prices can be rejected. High volume areas or high volume levels occur because there is a lot of trading activity inside those prices. Low volume areas occur because there is very little trading activity at those prices. Those areas are rejection areas. Usually when we see prices go into low volume areas, we'll see one of two things. We'll either see resistance or support, or we skip right through that area into the next high volume node or high volume area. Let's have a look at these components through an example. Here is a market profile chart of the S&P 500 futures. We're seeing multiple sessions profiles. So the first thing I'm looking for is support and resistance. And where to find that is using the value area highs and the value area lows. Here, I can see a value area low. Here, I can see both a value area high and a value area low. Next thing I'm looking for is areas of possible rejection. We can see here we have a low volume node, and also areas of attraction. Here we have a lot of volume. So noticing that prices opened here in the S&P 500 around 24.22, looking at these areas, I can safely assume that we should have resistance between 34 to 36. So I'd be looking to sell that area. Let's see what happens in the example to come. So you can see, looking at price action, this is where we had the value area low. Here's where we had the value area high and the value area low. Here's where we have rejection. Here's where we have attraction. So we wanted to be sellers between 34 to 36. And look at the reaction to the value areas marked. Prices enter the area, quickly exit, and move towards an attractor or a high volume node. And this is a great example of how to use these components and why they're so important. Now, I promised I'd make you all professionals in distributions, and that's what I aim to do. So here are the 3 key distribution shapes. When it comes to bell-shaped distribution trading, there are a few key distribution shapes we need to look out for. These 3 shapes can tell us what kind of market environment we're currently in, and even more important, it shows us where true value in the market is. Here are the 3 shapes. Number 1, P-shaped distribution. Number 2, B-shaped distribution. Number 3, D-shaped distribution. It is important to note that B shapes are lowercase, not uppercase letter B. Think of lowercase letter B or B-shaped distributions as an upside down P shape. Now, the P-shaped distribution is simply a positively skewed normal distribution. We call it a P because of its shape relative to how we view profiles for trading. It portrays a trending up pattern. We want to find a place to get long, and the idea behind the P shape is that it wants to retest the highs or trade higher. The characteristics are that a bulk of the distribution must be well above the open of the session. Here in this image, we can see the market opened here, and the larger bulk of the trading is well above the open. Next, we have a B-shaped distribution, and this is simply a negatively skewed normal distribution. We call it a B because of its shape relative to how we view profiles for trading. It portrays a trending down pattern. We want to be finding a place to get short, and the idea is to retest the lows or trade lower. Now, the characteristic on this one is a bulk of the distribution must be well below the open of the session. Here we can see the open of the session here, and the larger bulk of distribution is well below the open of the session. And finally, a D-shaped distribution. And this is simply a normal distribution. We call it a D because of its shape relative to how we view profiles for trading. It portrays a non-trending pattern or consolidation. Look to get long below value and short above value. Look to trade the edges of the market. The idea here is that the market is consolidating. It's not going any higher and it's not going any lower. And its characteristic is that the bulk of distribution must trade above and below the open of the session. Here we can see the open of the session, and we see a bulk of distribution above and a bulk of distribution below. Before we move on, we need to understand that all three of these distribution letters or distribution shapes are singular distribution profiles. For example, the letter P has one distribution. The letter B has one distribution. The letter D has one distribution. A combination of all three of these profiles inside of one will breed more than one distribution, and these are called multi-distribution profiles, or MDPs. A multi-distribution profile is a combination of more than one singular distribution. MDPs occur when the market is in a very defining trend. Recognizing MDPs is crucial for trading with the market profile. MDPs are very easy to visually recognize as well. There are a couple of visuals to really be on the lookout for, and those visuals are peaks and valleys. Peaks, these are the highest sections on the profile. They are called peaks because of their resemblance to a mountain peak. Valleys, these are the lowest sections of the profile, and they are called valleys because at the base of every mountain there is a valley. Singular distributions have one peak and no valleys, and MDPs have at least two peaks and one valley. In the example here, we have a multi-distribution profile with 3 peaks and 2 valleys, and here just a plain singular distribution profile which has 1 peak and no valleys. Before we move on to the next section, I want to go back and highlight one line. So when we were looking at 3 key distribution shapes, we look for these shapes to see what type of market environment we're currently in, but most importantly, it also shows us where true value lies in the market. And this is important to note, especially moving on into the next section, which is splitting the value of multiple distribution profiles. In order to unlock true value, we must be able to recognize multiple distribution profiles and break them into their normal singular distribution. This process is called splitting. There are many strategies out there based on both volume profile and market profile value areas. Most of these strategies are not wrong, but they are not reliable and very inefficient. The idea of using the value area is correct, but it is incorrectly applied. True value is found in singular distribution, thus true levels of support and resistance are found in the value area of singular distributions. For example, here we have a multiple distribution profile and a split multiple distribution profile. In the multiple distribution profile without a split, we can see a TPO value area high and value area low, volume profile value area high and volume profile value area low. Now we want to use these levels as support and resistance, and we did find some resistance at this level very inefficiently because we could see the market traded well above that level, and we found very little support at this value area low, and we could see the market traded well below that area. So the idea is correct to use these levels as support and resistance, but it's very inefficient and it's not correctly applied. When we split the distributions, we can see that we have a D shape followed by a B shape followed by a B shape. After the split, we can see that the value areas also experience a split of their own. Here we can see a value area high and low on this singular distribution, and here we can see a value area low and a value area low here as well. Now, look at how much more efficient this became. Now we were looking to sell and find resistance at these two levels very, very efficiently. And we also were able to find a low or support at this level much more efficiently than using the value area from a non-split MDP. And this is the real importance. True value was found here and here, not here and here. Our next topic is recognizing extensions of a range. And range extensions are the beginning of trends and the possible beginning of the formation of an MDP. Range extensions are also the bridge that connects one distribution to the other. It is important to note that range extensions are always made by single prints. Okay? Extensions on the profile are formed by the appreciation or depreciation of the value of the asset. It is considered the first leg or second leg of a rally or a sell-off. The best way to recognize these extensions is to find single prints. Now, single prints on a profile, on a market profile, are letters that are by themselves and don't have a letter to the right of them. Here, lowercase r are single prints. They're by themselves. Now, the first key to recognizing a range extension is to find single prints. We found it. Number two, see if there is distribution both above and below the single prints. Here we can see distribution above and below the single prints. So we definitely extended the range from this profile from this distribution to that distribution. Here we also extended the range between this distribution and this distribution. And as you can see, this was leg number 1 on this sell-off, and this was leg number 2 on the sell-off. Big sell-off here on this profile. Up to this point, we have educated on the market profile and explained how we get an understanding of price and time. In order to make further sense of what is happening below the hood of the market, we use a real-time log of all of the orders that are executed in the market. This is how traders account for volume. Knowing this information keeps us on the right side of the market, since we are aligning ourselves with the winner between buyers and sellers. Put another way, we follow the money by understanding volume. To read volume, we use the order flow and the order flow footprint. So what is the order flow footprint? The order flow footprint is an executed volume log like time and sales, but built into the candlesticks within a price chart. The indicator displays the total executed volume on both the bid and the ask. It is literally a digital footprint of how many contracts have been executed at each price. The order flow footprint is useful in tracking the total sentiment of volume in the market. Typical volume indicators only add the total volume per specified period, but it is impossible to distinguish how much volume is selling and how much is buying using other indicators. The footprint's algorithm can automatically decipher the buy volume, which is the buyers, and the sell volume, which are the sellers. We take it a step further and determine the exact price the institutional volume is being bought or sold. The algorithm can see larger than average orders that are executed by highlighting the specific prices these orders were executed at. When thinking about volume, there are two sides, the buyers and the sellers. These orders are the basic fundamentals of trading. One person wants to buy what you're selling, and another person wants to sell what you want to buy. This relationship is called the bid-ask spread. The ask is what the market is asking of you to be a buyer of the market. The bid is what buyers are bidding for what you are trying to sell. Short and simple, ask equals buyers and the bid equals the sellers. In this example, we can see the difference between the ask volume and the bid volume on the order flow footprint. On the right side, we can see total executed volume on the ask, which is the buyers, and we can see the total executed volume of the bid, which are the sellers. This next slide is food for thought. So fact, myth, or conspiracy? Here's a question to ponder. Is there really a buyer for every seller? Is that a fact or a myth or a conspiracy? This question is always a confusing one, and it makes us really think about how the market really works. It is okay to believe that this is true, but it is also okay to believe that it is not. At this point, without knowing exactly how the market really works, it really just comes down to opinion. But in science, for a theory to be true, scientists conduct experiments and they must get the right answer, the same answer every single time. When looking at the footprint, how can you explain different values between the bid and the ask for specific prices? How do you explain slippage, and how do you explain net delta imbalances? Here on the image next to the text, I highlighted an area, and this is true almost everywhere, where the ask is greater than the bid or the bid is greater than the ask. If there were really a buyer for every seller, wouldn't we see 87 on the ask and 87 on the bid, or 21 on the bid and 21 on the ask? Why is there a difference? Could it be that there were more buyers than sellers? I like to believe so, because we see this continuously. It is true time and time again. So what's a net delta imbalance? And what is slippage? I'll get to those. But first, net delta imbalance. In order flow, the net delta imbalance is the total number of executed volume on the ask side minus the total number executed on the bid side. A positive number will determine that there was more volume executed on the ask, and conversely, a negative number will determine that there were more volume executed on the bid. Can we take this to be that a positive number means that there are more buyers than sellers, and if negative, more sellers than buyers? Sure. So here's the formula. The ask minus the bid equals the net delta. The imbalance shows us the sentiment of the market through the view of executed volume. This is what makes the imbalance reliable and important. It is true executed volume through an official exchange, and the total imbalance shows us whether we had more buying or more selling per trading session or per specific time frame. Ultimately, this helps us weed out the noise surrounding financial markets and garner a true understanding of market internals. Here on the image, at the bottom of each candlestick, we see a negative number or a positive number, followed by a color. Negative number means more executed volume on the bid than on the ask. Positive value means that there were more executed volume on the ask than on the bid. Taking a look at what the color means, when we take a look at our footprint algorithm, we assign the color for each imbalance. If we see a very bright red, it means that the bid volume is greater than the ask volume by 50% of the difference between the two values. If we see a very bright green, it means that the ask is greater than the bid by 50%. If we see a light pink, it means that the bid is greater than the ask by 15 to 49%. And if we see a light green, it means that the ask is greater than the bid by 15 to 49%. A light blue means that the ask is greater than the bid, anywhere from 0 to 14%. And if we see yellow, it means that the bid is greater than the ask by 0 to 14%. So here we can see the order flow tracking algorithm deciphering how strong the conviction is by the buyers or the sellers, right? Bright green and bright red means strong buying and strong selling. Light green and light red means moderate buying and moderate selling. Light blue and yellow means that we have weak buying and weak selling. So taking a look at the difference between market depth and executed volume. This is extremely important. Market depth is another word for orders that are away from where the current market price is, that show the intent to buy or sell. I like to call these levels inventory, simply because it is supply that has not been involved in any sort of transactions. These orders are considered pretty much useless. I mean, this is not valuable information whatsoever because it is not executed volume. Sure, it shows the intent to buy or sell, but at any point in time, these orders can be shifted to different prices or just canceled before the market executes those orders. This is why the footprint is more reliable and a very powerful tool to have, because we are actually seeing orders that have been executed versus orders with the intent to buy or sell. Our next topic is going to be slippage. And so what is slippage? Slippage occurs in electronic markets every single day. Slippage is when there is a remarkable amount of volatility and a lack of liquidity. When a market becomes illiquid, it can skip through prices without filling orders on the way up or on the way down. These events are viewable through the footprint. We see them as prices in between the high and the low, with zero executed volume on either the ask or the bid. If you happen to have a stop loss or profit target at a price that gets slipped, what the market will do is fill your order at the most readily available price. This can have both positive and negative effects. If we have a target in place that happens to get slipped, it is possible that you get filled at a better price with more profit, which would be called positive slippage, or at a lower price with less profit, which would be called negative slippage. Here on the example, we can see evidence of slippage. In between the high and the low of the bar, we can see prices that were just skipped. Anyone who was on the ask at these prices did not get filled. They got filled at the next readily available price. And here on this bar, we can see on the bid a couple of zeros, 2 ticks of slippage. Anyone on the bid at these prices did not get filled at those prices, but at the most readily available price. Another great feature of our footprint algorithm is that we can detect institutional buyers and sellers. So with the footprint, we can also see specific prices where institutional order flow is evident. Institutional traders are just like you and me. They pick specific prices where they want to buy and where they want to sell. Because of the size of the trades from these players, they have the most power to move the price of an asset. This means that when they buy or sell, they definitely move the market. Whether they move the market 1 tick or 10 ticks, they move the market enough to leave some ask inventory or bid inventory behind via slippage. This kind of slippage is not visually visible because orders have been executed at that price, but slippage does occur. So during this slippage, we can detect larger than average volume by comparing the ask to the bid, which would be buying, or comparing the bid to the ask, which would be selling. Our footprint algorithm detects these instances and highlights these areas for visual confirmation of institutional buying or selling. Here we can see that institutional buyers are highlighted in blue. They came in at very specific prices on this bar. And we could also see institutional sellers highlighted in yellow. Our software can keep you on the right side of the market by allowing you to view where value truly lies in the market, where the market wants to be rejected and attracted to, the distribution shape, and also who is buying and who is selling the market. This is extremely valuable information for any trader, and we offer it all in one chart. market profile, and order flow footprint all in one chart, with the market profile be on the right side of the market by using an indicator that the institutions use. The ability to see distributions by what they really are composed of, with the ability to split them. Know where true value lies and take advantage with this information well before the market reacts. And with the order flow footprint, track the imbalance of the market and know what side to be on. See institutional volume, what exact prices they're doing business at, and track the cumulative imbalance of the market per session to see the true sentiment of the market via actual live trades. Here's what our software looks like for the NinjaTrader 8 platform. Here we can see the profile view. And in profile view, we see a TPO profile with letters and a volume profile laying behind the TPOs. We can see the TPO value area. We can see the volume profile value area. And we could also see a single print tracker, which tracks the single prints that are above and below value. And if I wanted to split any one of these multi-distribution profiles into their singular distribution forms, all it takes is just one quick click of the mouse and the profiles will automatically split for you. Looking at the hybrid view, in this form we can see the profile alongside price action in the form of candlesticks. We could also see the footprint infused into these candlesticks. And if we zoom in just a tad more, we can see the footprint completely infused into each candlestick. We can see the executed volume on the bid and on the ask. We can see where institutional order flow has been highlighted. We can see the volume weighted average price, or VWAP, as well as time weighted average price, or TWAP. And at the bottom of the chart, we can see the order flow imbalance tracker. At the bottom right hand corner, we see a blue number. This is the cumulative net imbalance for the entire trading session. So as you can see, what we have created is an all-in-one trading experience and indicator. We combine the market profile and order flow footprint in a visually rich display to make trading this amazing strategy much easier than conventional market profiles. These tools are not available on your standard trading platform, but thanks to traders like myself, we can make these institutional grade indicators and tools available to you, the individual trader. If you'd like to know more, please come and visit us at www.themarketprofile.com and get your 14-day free trial alongside my futures trading room, where I trade index futures, commodities, and interest rates, and more. You will also have access to my portfolio spreadsheet, and even more importantly, you'll have access to me. During the 14-day free trial, I will educate you on the functionalities of the indicator and show you how to become a better and more consistent trader with my tools. Also, sign up for a free account at www.TechMeetsTrader.com, where we can continue talking more about the market profile. TechMeetsTrader is a Facebook-like social community of active traders and investors where we all share our ideas and trades and even create and join groups. It's a great platform to learn from others, and it's a great way to stay in contact with other great traders. Thank you all for your time, and I will see you all in the trading room.